if you're facing the right direction, all you need to do is to keep walking. We are walking the investing bylanes with the erstwhile CIO of IDFC Mutual Fund, Kenneth Andrade. Kenneth, welcome back. Kenneth, you talked about Michael Milken, junk bond, 1980s, but he said democratization of capital was happening. Do you see that happening in India?
The first phase has happened, and I think that's just expanding itself to the smaller companies right now. But I think the big changes that will happen is when leverage in the personal balance sheets actually take place. If you look at RBI data on banking loans, 67% of all loans go to corporates. Okay, close to about 14-20% goes to mortgages. What's going into personal leverage is just about 4 or 5%. So the potential for that to increase significantly on a lower base. Okay, I mean, not only just helps de-risk the banking balance sheet, but essentially takes capital down to the least common denominator of our society, because there are a lot of smaller businesses down there, and it's established as a fact that microfinance companies are growing at this pace.
Okay, let me get you back to 2000, which was very organized. You now are in IDFC. Did you feel the pressure?
I like what I did. Okay, and more than there was a little bit of pressure on performance, on relative comparisons, etc., etc. But I think the main joy of it all was getting things right, was being first in a business, was holding on to it for a decade, and actually seeing the company actually transform in terms of its P&L and in terms of balance sheet. I think there was more joy than there was pressure in the entire.
More joy than pressure?
More joy.
You're the first fund manager to tell me that. But the joy was in the markets. 2002-03, a great bull market had started in India. In retrospect, we know that. How were you placed at that time? What made you convinced that a bull market was beginning, or were you convinced?
I mean, I wasn't looking at it from a bull market or a bear market. Essentially, we were looking for nice companies, irrespective of what the environment is, they continue to do well. Okay, so if I can fast forward it a little, my best performance in all my funds came in when the markets were between 15,000 and 20,000.
Right.
And that's the time the NAVs actually went up 3x. Just got your companies right.
You've often said that you like investing in monopolistic businesses. How does that help you?
The paint segment, or the decorative paint segment, is one industry where it's shown how a monopoly can be created virtually out of cash flows. Okay. One company in the industry accounts for close to about 70% or probably 80% of all the cash flows in the business.
Right.
Okay, and that hasn't changed for an extremely long period of time. You had it in tobacco, but that was for a different reason altogether. And in the initial stages, you also had it in some of the pharma companies in India till fragmentation came through. When I talk about monopolies, monopolies are essentially come out from businesses which are consolidating. So it's nice to look for an industry which is making losses and one company is making a profit.
The other thing that you've always emphasized is efficiency of capital. What is that, and how do you gauge it?
I think one of my favorite ratios out here in terms of picking companies which is market cap to sales, or EV to sales. And in an industry where margins are under pressure, and if a company is actually dropping balance sheet to increase sales, and profitability is not there, I think you got the company right.
Say that one more time, I need to understand that.
Okay, so if a company has got no profitability, right, but is dropping balance sheet and increasing the sales turnover, you got a company right.
Give me an example of a company that you found that was taking a fragmented industry, consolidating it, and the balance sheet power was going through.
I think one of my longest holdings in my career has been a company called MRF.
Really?
Okay. And the interesting part of this company was in year 2002 when you actually saw that company. His total enterprise value was equal to his gross profit. So really? The market actually didn't pay him any value for the rubber he purchased. And over the last 15 years, this entire matrix is converted. The stock currently trades at about 1.3 times sales, market cap to sales. So that's how the transition took place.
Another stock that you've been associated with that you've had a great winner was Page Industries. Tell me about that story.
Fragmented industry, one company in there, consolidating, been around, return on capital employed was 25%. And he came in, 17 times earnings. At that point in time, a little expensive. But if I looked at him on a 3-year cycle, he would have double profitability.
Did you ever see pain in that stock, or was it once you bought it, it kept going up, so there's no pain?
Well, a lot of these companies don't do anything for 3 or 4 years. Okay, and Page Industries didn't do anything for quite some time. On listing, it actually listed 20% lower than its IPO price.
Really? So what gave you the confidence to sit through that? I mean, you're still, not seen it all, done it all.
If you're watching the screen, you'll hit the button. If you're watching the balance sheet, you'll probably buy more.
All right, now then your stocks become winners, right? You have Page Industries has doubled and then doubled again. When do you take money off the table?
We go back to the qualitative part of the industry, and also when I say that we like monopolistic businesses or we like consolidating businesses. If I look at the inverse of it all, I think one of the biggest successes in my career have come by avoiding the capex boom, or we were virtually out of capital goods, equipment, infrastructure in 2008, 7, 8. Early, and valuations were all over the place. You were getting paid for order book and not profitability. Also, that inflection happened when you compare two companies, and IVRCL was trading at 17 times earnings, and Hero Honda was at 5% dividend yield.
Correct. It's a no-brainer to one studying the books, right?
Yes. So, if you looked at the price, if you looked at the market, if you looked at where all the action was, you probably ended up with the wrong company.